1 million barrels of Emirati crude oil reportedly arrived at the UAE's main terminal at Fujairah port through a newly built pipeline on June 21st. By July, the UAE is expected to export nearly half of its crude without having to pass through the geopolitically volatile Strait of Hormuz. This is the first major move by a Gulf Arab state to shift the majority of its output away from Hormuz to more secure export zones in the Gulf of Oman. But it's going to take a lot more work, investment, and diplomacy to significantly undermine Iran's leverage over this critical sea lane. Roughly 40% of the world's seaborne crude passes through the Strait of Hormuz every day. This gives Iran enormous leverage. Stratfor has highlighted time and time again that nuclear weapons aside, an Iranian attempt to close the Strait of Hormuz and traumatize the global economy is the strongest form of deterrence Iran has against a potential military strike by the United States and Israel. This naturally puts the oil-exporting Arab nations in a difficult spot. These countries do not want to see a military confrontation in the Persian Gulf that would take their business offline, and so they see the need to diversify their export options. At the same time, these states share a U.S. interest in psychologically convincing Iran that it's not immune to attack and thus cannot afford to shun negotiations that aim to curb Iranian influence. So let's look at the Hormuz alternatives. The UAE Pipeline, which the Chinese helped construct, has the potential to reach capacity of 1.8 million barrels per day. In conjunction with this project, the UAE is investing a lot of money into shifting its main export and refining facilities to Fujairah, with the intent of making this port the Singapore of the Gulf of Oman. The EastWest or Petro line, which transports oil from Saudi Arabia's eastern province to Yanbu port on the Red Sea, has a nameplate capacity of roughly 4.5 million barrels per day. However, this line is only transporting 1.9 million barrels per day. This is a route that makes sense for European markets, but it's still a longer and more costly route for Saudi to supply large Asian markets to the east. A U.S. proposal has been made to raise the capacity of this line to 11 million barrels per day. This would not only accommodate all of Saudi Arabia's crude oil export needs, but with sufficient left over to handle all of Kuwait and Qatar's as well. EPSA is a 1.6 million barrel per day line that originates in southern Iraq down through Kuwait and then runs parallel to the east-west line across Saudi Arabia. This pipeline has been out of operation since the first Gulf War, and it's going to require a difficult political negotiation between Saudi Arabia and Iranian-influenced southern Iraq to bring this line back online. The Trans-Arabian pipeline runs from Saudi Arabia's eastern province, then runs northwest through Jordan and Syria, and then ends at the Lebanese port of Sidon. This has been out of commission since 1990 and is extremely politically complicated to negotiate transit. Lastly, there is the Kirkuk-Ceyhan pipeline, with a nameplate capacity of 1.6 million barrels per day. This connects northern Iraq to Turkey for export to Western markets. The line is operating at about 1/3 of its capacity due to insecurity and lack of production. Turkey and the Kurdistan Regional Government may be developing another export line that would bypass Baghdad's authority. If a connector is built in Iraq from Haditha in central Iraq to Ba'ji in northern Iraq, then more southern Iraqi oil could reach Turkey's Mediterranean ports. However, sectarian tensions will continue to hamper those plans. As Iran continues to highlight its leverage over the Strait of Hormuz, we can at the very least expect to see more Western and Asian interest in the GCC states to build up these alternatives. This is a trend that will take considerable time to develop given the array of constraints, but it is a trend that bears close watching in assessing Iran's position in the Persian Gulf.